Welcome to the opportunity of a lifetime. There is an upcoming debt crisis that could potentially be a $1 trillion problem, and we have 24 months to solve it. So enjoy the course. In this course, you'll be guided on how to create a steady stream of listings by mastering the analysis and understanding of distressed debt. Our primary focus is to empower you to generate listings both immediately and in the long run, while also providing you with the knowledge and skills to profit from facilitating various aspects of real estate debt. This training course will make you a DDREX. That stands for Certified Distressed Debt Real Estate Expert. Introduction. We're going to show you how to approach banks, lenders, and asset managers to gain exclusive access to their real estate portfolio holdings of non-performing loans, which will enable you to see creative pathways and explore alternative earning and investment opportunities. Through this certification, you'll be able to market yourself to your audience as a certified distressed debt real estate expert, standing out in a noisy, oversaturated industry in a niche area of the market that needs help. Add this additional tool to your toolbox and let's get to work. Historical macro data of CRE, how we got here and why we are here. A decade of near 0% interest rates led to an unprecedented rise in commercial and investment real estate. Rapidly rising rents in both the commercial and residential sectors, combined with a steep decline in the cost of capital, along with uneducated and overly optimistic entrepreneurs, continually fueled the real estate boom of a lifetime. Distressed CRE market education, understanding distressed debt in the industry. What is distressed debt and the different types? Distressed debt is categorized as part of the leveraged and high yield loan market and is rated below investment grade debt. The various types of distressed debt in the industry include: one, payment default. This occurs when borrowers are not making their scheduled loan payments. Two, loan maturity default. This type of default happens when the loan term has ended and the full balance of the loan is due, but the borrower is unable to repay. A potential option would be an inability to refinance. Distressed debt can also arise from a borrower's inability to secure refinancing for their existing debt obligations. Number three, combo defaults, a situation where multiple types of defaults are occurring simultaneously. So who holds this distressed debt? Distressed debt is held by a variety of entities in the financial landscape, including local and community banks, public and private asset managers, large investment and financial institutions, Wall Street, and special servicers. All of these individual entities have different types of distressed debt. You need to make sure you get to the ones that actually hold the majority of real estate. Who holds distressed debt? Part two. It's important to note that banks cannot afford the negative publicity and headline risk associated with distressed debts. By offering a professional first-class service to solve their problems, you are addressing multiple issues they face, including capital, lost revenue, legal exposure, regulatory audits, and damage to reputation. For example, a bank like M&T Bank being perceived as not supportive of the consumer or small business owner can be detrimental to its goodwill and reputation. Now let's take a little interactive break. I want you to think and write down the names of at least 5 people that you know that are actively fixing and flipping real estate, own commercial real estate, have expressed interest in investing in real estate, and or manage real estate, such as property managers. Great. Hopefully 5 names came to mind. If they didn't, still think about it. Let's move on to the next slide. So strategy, why banks need you. Prioritize reaching out to local banks is essential, and here's why. Connecting with your local bank as soon as possible is critical for several reasons. One, they're understaffed. Two, management is disconnected from the reality of the market. And three, everyone's seeking new relationships. It's crucial for you to be first in their minds when the DDREX calls for you to be the solution provider. Establishing yourself as the go-to expert in distressed debt management can position you as an invaluable resource for banks struggling with these challenges. Here's a strategy. Money talks. Local banks need deposits to continue lending and to reduce their cost of capital, which is essential for maintaining their net interest margin, better known as NIM. It's cheaper for them to borrow money from the consumer than the federal bank. The number one way to become irrelevant to a local bank is by transferring your deposit relationship to the bank along with any clients friends or family members you may have that have $250,000 or more parked at another bank. That's critical to getting your foot in the door. Today's federal home loan bank rate is about 4.48%. So if bank lends at 6%, they only make 1.52% margin. However, if you deposit money into a savings account with a 2% yield from the bank and they lend at 6%, their interest margin increases to 4%. Banks are highly motivated to acquire your deposit relationships. If direct relationships are not feasible for you, you'll need to play the longer game by connecting with key individuals within the community bank. These include the branch manager, the residential mortgage loan officer, the chief lending officer, the commercial loan officer, and or the portfolio or asset manager. The portfolio and asset manager are the ones that usually make the final decisions before presenting these opportunities to the board. So the best way to get to them is by getting to the residential mortgage loan officer and the commercial loan officer, because they have to work directly with the asset manager. And oftentimes those are loans that these two categories had originated or brought into the bank. Try to secure meetings with the higher ups of the bank and build relationships. Having the DDREX certification positions you as the expert in the space, allowing you to effectively present yourself as a valuable resource in managing distressed real estate debt. Navigating challenges with larger financial institutions and asset managers. Engaging with larger financial institutions and asset managers presents its own set of problems and hurdles. Unlike local banks, these entities typically do not face as severe liquidity crunches or cash issues. They deal more so with mortgage-backed securities and commercial mortgage-backed securities. The best way to establish connections with these firms is through existing relationships and contacts. The most effective method to gain access is by being referred by a borrower who currently has a loan with the firm. Leveraging such referrals can open doors and facilitate meaningful conversations with key decision makers in these larger entities. Reaching real estate owners in need of your expertise. You guys all have clients, and if you don't, here's your way to get them. The most effective way we recommend for sourcing clients in need of distressed debt expertise is through transactional real estate attorneys, litigation attorneys, and bankruptcy attorneys. The majority of commercial and investment real estate owners maintain close relationships with their legal team and often trust them more than any other professional service provider. If you get to them, you can get to the client. If you don't have contacts with these legal specialties, we suggest tapping into your network to get personally referred to them by someone you know, like, and trust. Our next suggestion would be aim to set up a breakfast, lunch, or dinner meeting with these attorneys as soon as possible. And remember, it's a good gesture to pick up the bill. During these meetings, educate them about your DDREX certification designation and express your intention to delve deeply into this market. Also, communicate your willingness to refer them business back in return. This approach is not just about building a network, it's about establishing a mutual professional relationship that can be beneficial for both parties. So probably thinking, well, that's great. How can we earn? Well, the opportunities to earn by identifying distressed property owners are as follows. When dealing with distressed property owners, it's crucial to first identify their primary goal. Do they wish to keep the property or are they looking to sell? If they want to sell, your opportunity lies in securing the listing and finding a buyer. This approach allows you to assist in a smooth transaction process benefiting both the seller and the prospective buyer. Now, if they want to keep, it gets a little bit more complicated. Facilitate the restructuring or refinancing of their debt. This involves working with lenders and financial institutions to find viable solutions that allow the owner to retain their property. Or 3, get creative with consulting and advisory services. Offer specialized consulting and advisory services. This can include providing market insights, strategic planning, and negotiating assistance. It's about bringing creative solutions to the table that go beyond traditional buying or selling roles. Each of these paths offers unique opportunities to leverage your expertise as a DDREX and make a significant impact in this distressed real estate market. Interactive break. Under construction. Note, any real estate projects you are aware of that are currently under construction. Developments under construction often carry overextended debt, especially in light of market interest rates and conditions. When you're driving in spot cranes or construction materials, make note of the address. You can then research this address using Google, your local MLS, or property records to determine the initial purchase date of the land project. If the project commenced before 2023 of July, it might face future challenges. Projects that started prior to July 2022 are likely dealing with more urgent issues. These could include budgets exceeding initial estimates, overestimated rental cash flow projections upon completion, matured or soon to be maturing loan debt, and possibly being already on extension. So I want you to take a couple seconds and think, when's the last time you saw a project being built, whether it was residential or commercial? Write it down. and let us know when you're going to go drive past it. And the key is to get to the owner. If there are people working on the site, get out of your car, go talk to the guys on the site, and find out who's in charge of the project. It's a great way to get information, and no one else is doing it. The cash flow calculator. This is the secret to success. We'll be reviewing this in depth later on. However, it is critical that you understand how to navigate this on your own. With just about 10 clicks of buttons and changing of information, you can determine immediately at your fingertips the maximum qualified loan amount for a real estate asset. It gives you today's real accurate information. Let's get started. Here's a scenario. The property owner wants to sell. When the goal is to sell a property, your first step is to utilize the cash flow calculator to determine the maximum loan amount based on real-time income and expenses. This tool will enable you to position yourself effectively to secure the exclusive listing. Example of selling a distressed property. Assessing financials. Identify the difference between the current distressed loan balance and the maximum loan amount as indicated by the cash flow calculator. If this number is negative, the current distressed loan amount exceeds the CFC's maximum loan amount, it may be prudent to focus on temporary loan restructuring or modification. If the number is positive, the current distressed loan amount is less than the CFC's maximum loan amount, consider approaching the bank to discuss a short-term interest-only loan while seeking and identifying the buyer. The goal, secure the listing and find the buyer. Your immediate objective is to obtain the listing and bring a qualified buyer to make an offer. Successfully closing the deal not only benefits the seller and buyer, but also positions you as a solution provider to the bank. This can lead to the bank bringing other similar internal scenarios like this one to you, the distressed debt real estate expert. Considering short-term bridge loans. Short-term bridge loan might be a viable option to buy time for restructuring the debt or repurposing the real estate. This could be facilitated through services like Verify Capital, Bridge Loan, Fee Share. By following this approach, you demonstrate your capability in handling distressed property sales and establish yourself as the go-to expert for banks and property owners alike. When the property's owner's goal is to retain the property, a thorough financial analysis using the real-time cash flow calculator is crucial. Here's how to proceed. Accurate financial assessment. Obtain an up-to-date payoff letter from the lender, which should include all fees, default interest, taxes, and insurances. This step is essential to determining your target loan amount accurately. Please do not assume, as most lenders do not issue accurate payoff letters that are inclusive of all costs and fees. It is critical to know your target to avoid wasting time on hypothetical scenarios. Debt restructuring proposals. Propose a debt restructuring plan back to the existing lender. This involves negotiating new terms that are more manageable for the property owner. Alternatively, propose a new loan offering to a different lender, which could be a bank or bridge provider. Introducing new investors. Consider bringing in a new equity investor or limited partner into the deal. This can infuse fresh capital and help in restructuring the current financial obligations. Understanding potential earnings. Be aware of the hypothetical gross fee percentages. On average, expect around 1% for managing debt restructuring and about 3% for introducing equity. An example on this would be a $1 million debt offering can make about $10,000. However, for bringing in $1 million of equity, the gross fee would be roughly $30,000. By following these steps, you can effectively assist property owners in maintaining their properties while navigating through their financial challenges. This approach not only aids in preserving the property, but also opens up opportunities for earning through professional fees. Get creative with consulting and advisory services. When traditional solutions don't fit, getting creative with consulting and advisory services can be a lucrative avenue. Here are ways you can structure your fees and other services. Fee structure. Charge by the project. Charge a flat fee. This gives the client a clear understanding of costs up front. Or you can charge by the hour. I suggest a rate of approximately $375 per hour. This can be adjusted based on the complexity of the work and your level of expertise. Other services you can charge for. Lease review. Analyze all the leases and provide a full assessment of current rents versus real-time market rents. For example, show how increasing rent from $2,000 a month to $2,800 a month can add $9,600 per year to the rent roll, potentially leading to a $100,000 higher loan amount. Expense review. Scrutinize all current expenses such as taxes, insurance, water, sewer, maintenance. Often the easiest way to increase a real estate owner's profitability is by identifying savings in current expenses. Start by examining the insurance policy. as premiums often increase annually with the same carrier without being competitively shopped. Finally, zoning and redevelopment opportunities. Investigate the property zoning and see if it allows for repurposing or redevelopment. Value-adding possibilities. Present the property owner with options to enhance the property's value, such as adding additional square footage or exploring joint venture opportunities for more profitable real estate development. Interactive break. Experiment with the cash flow calculator. Test various hypothetical numbers and scenarios, such as increasing taxes and insurance costs and decreasing rental income. Observe the impact of these changes on the overall cash flow, specifically the DSCR. Be inventive with the amortization periods. While most banks prefer a 20-year term, they may consider a 25 or 30-year term when restructuring a deal. Top solutions to bring loans out of distress. You need to get all the facts. That's crucial. And it's also crucial that you have to act swiftly and gather all the pertinent facts to effectively bring a loan out of distress. Here are some of the top solutions you can consider. One, pay off the debt with fresh capital, which means you're going to secure new funding to completely pay off the current debt, clearing the way for a fresh start. Two, forbearance agreement with current lender. Negotiate a forbearance agreement where the lender agrees to temporarily reduce or suspend payments, provide some breathing room for the borrower. Three, refinance with the current lender. Work on refinancing the loan with the current lender, possibly securing more favorable rates and terms. Part two, refinance with a hard money or bridge lender. Consider alternative financing options like hard money or bridge loans, which might offer more flexible terms for distressed situations. Pay the outstanding delinquent balance to reinstate the initial loan. If feasible, bring the loan current by paying off the delinquent balance, thereby reinstating original loan terms. Oftentimes, a creative way to do this is through cross-collateralizing additional assets, so be sure to ask all the questions. If a payment default is in existence, address the payment default issue by restructuring the debt or exploring other financial arrangements. Number six, bring on an equity partner or LP, limited partner investor. Introduce a new equity partner or LP investor to the deal to infuse additional capital and stabilize the financial situation. Office problems to residential solutions. With the rapid increase in vacancy rates and the extreme rise in corporate bankruptcies, those office buildings we pass by daily are facing severe challenges. Here's a tip. If you spot an office for lease sign or advertisement, reach out to the owner to discuss their debt situation and explain how you can assist them. Office buildings are said to be overbuilt by 3 times the current need in America right now, and that number's only increasing. Every day, people are leaving the office. Few companies are actually starting out in offices these days. So keep that in mind and target this asset class. Top tips: trust but verify. Always verify the information provided to you. Trust is important, but in financial transactions, verification is key. Rent verification. Inquire about the rent, of course. Obtain copies of the leases, of course. Request the last 12-month bank statements. Why? Because you want to highlight each rent deposit in the bank statements to confirm that the rents are actually being paid and in the amount they're being paid or said to be paid and actually being received by the owner. Top tips. Trust but verify part 2. Comprehensive data review. This verification process should be applied to all data provided. This includes but is not limited to property taxes, property insurance, current loan balance, current loan payoff, date of initial property purchase, date of loan delinquency, date of loan maturity. Checklist utilization. Be sure to review the checklist included with this course. It is designated to help you cover all bases so nothing gets overlooked. Here's an example and case study. A builder purchased a property for $450,000 back in December of 2021. The builder demolished the existing structure to construct a new luxury single-family home. To finance this project, the builder obtained a construction loan of approximately $750,000 for 18 months from a fix and flip lender. By June of 2023, the loan came due, meaning the entire loan balance of $750,000 was required to pay back. This loan could not be extended as the interest rate was 3% lower than current rates for construction loans. Despite this project still being unfinished and $80,000 was left in the builder's fund's escrow account, the lender refused to release these funds since the loan had matured. Consequently, the loan entered into default, accruing interest at 22%. As of June of 2023, the builder was approximately at $150,000 short of completing the project. In November of 2023, the lender initiated legal action for foreclosure. Within 2 hours of receiving this notification, the builder was referred to our team by another builder in the network for an immediate short-term bridge loan to pay off the foreclosing loan. Upon confirming the ability to fund this bridge loan through verified capital within 1 week, we approached the foreclosing lender. We successfully negotiated the removal of all default interest accrued since June, which was $22,000, contingent upon paying off the loan in full within 7 calendar days. Here are the benefits to the borrower. Utilizing the solutions provided in this course can offer a significant advantage to borrowers facing distressed real estate situations. These benefits include avoiding costly litigation and legal fees. By proactively addressing loan distress scenarios, borrowers can circumvent the need for expensive legal proceedings. 2, reducing mental stress and worry. Finding effective solutions to financial challenges alleviates the psychological burden associated with distressed loans. 3, establishing a perfect mortgage history. Successfully restructuring refinancing loans allows borrowers to rebuild and maintain a positive payment history. Benefits to borrower part 2. Avoid public humiliation. Resolving financial difficulties discreetly helps prevent public exposure of financial struggles, protecting the borrower's reputation. 5, completing projects without negative cash flow impact. By incorporating costs such as loan payments and fees into a new bridge loan, borrowers can continue on their project without the strain of immediate cash outflows. These benefits not only help in the immediate financial recovery, but also contribute to long-term stability and success for the borrower. Here's an example of a deal that was recently funded due to DSCR cash flow constraints. On August 7, 2023, our client entered into a contract to purchase a mixed-use property in Jersey City, New Jersey. The agreed-upon purchase price was $1.125 million, with the client making a down payment of $112,500. The contract stipulated a 60-day closing period, setting an approximate closing date of October 7, 2023. Outlined below are the key facts of the case. The seller of the property unexpectedly passed away and ceased making mortgage payments, which means the loan was now in default. The first residential unit was rented for $1,800 per month, while the fair market rent was actually $2,800 per month. The second residential unit was vacant, but its fair market was also $2,800, and the commercial space on the property was rented for $2,500 a month. Real estate taxes for the property amounted to $18,000 annually, and the yearly cost for property insurance was $5,000. So on this cash flow analysis, you can see that the loan amount we were able to help apply for through our capital solutions was $610,000. We estimated an average interest rate of 7.5%, and we plugged in all of the rents, residential 1, residential 2, and the commercial space. As you can see on the top right, the DSCR was 0.31, which was much lower than the 1.25% requirement. So what we were doing on this scenario is actually structuring commercial financing to pay off the bridge financing we were going to facilitate, but you can't facilitate bridge financing without understanding how you're going to get paid back. Here were the expenses on the property, which totaled about $30,000 for the year. And here's what we ran as a hypothetical cash flow calculator analysis. As you can see on the top right, the DSCR is now 1.26. So you're probably going to ask, how did we get there? Well, the first thing is real interest rates in today's market environment are closer to 6.5%. So we dropped the interest rate from 7.5% to 6.5% to make up for market volatility. And we actually put the property's rent at fair market rent. So we increased unit 1 to $2,800. We assumed unit 2 would also be rented for $2,800. And we increased the restaurant's rent from $2,500 to $3,000 because that lease is coming up next year. So by putting our client in a 1-year bridge loan, we know that by lending this money in 1 year, as long as interest rates remain between 6.5% and 7%, we will be able to exit our capital investment and repay our terms through a commercial bank that will reimburse us in full. Jersey City Solution, Commercial Bridge, Part 3, Main Points and Key Takeaways. Currently, most banks and lenders base their lending decisions existing on the cash flow that's accurately depicted on the property in real time. This explains why the purchaser of this asset struggled to obtain traditional financing for over 4 months. The obstacle was the unrecognized fact that the property's cash flow is in fact negative. A common misconception among real estate professionals is that 25 to 30% down requires a guaranteed loan approval. However, in commercial and investment real estate, loan qualification primarily hinges on the debt service coverage ratio. Regardless of down payment size, if the DSCR does not meet the bank's minimum threshold, typically around 1.25%, the loan is likely to be denied. In this particular case, I believe the client actually overpaid for the property by about $250,000. He went into the property, not real estate was actually valued, investment real estate was actually valued. The property may actually be worth, but based on the maximum cash flow analysis and current interest rates, this property is worth $900,000, which is why we only lent $110,000. We felt that extra education. So here's a time where you guys can think of other questions that you guys need answers. What's going through your mind? What can we do to help you become more valuable in this space? Write down some thoughts and ideas to share back with our team exactly how we can help. What are you seeing in the market? Let's take a couple seconds to do that. Let's look at the historical yield curves real quick and see the upward rising of trend. As you could see, based on rates, there's a lot of overlap. Long-term debt, short-term debt. This is something to be very mindful of. Here's an in-depth understanding of the real estate capital stack and debt position. The capital stack in real estate financing represents the different layers of financing sources that go into funding property investments. The positioning of a piece of debt within the stack determines the order in which lenders are repaid in the event the borrower is in default or bankruptcy. Each layer of the capital stack carries various degrees of risk and return, with the position indicating the priority of repayment. The components of a real estate capital stack typically include a first mortgage position, a second mortgage position, mezzanine debt, preferred equity, and equity. Understanding the nuances of the capital stack is crucial for real estate investors as it influences both the risk and potential returns of an investment. Different positions in the stack can offer varying strategic advantages depending on the investor's risk tolerance and financial goals. Final thoughts. Decide the amount of time you will dedicate each day to generating and nurturing this type of business. The better prepared you are for upcoming challenges, the more valuable and ready you will become. Estimate how long it will take you to identify at least one distressed debt situation. What are your top 3 strategies based on what you've learned today in the certification for immediate prospecting? Questions? Awesome. Feel free to contact us at any time. Email us, text us, simply give us a call, or even schedule your own webinar with other professionals you believe will benefit from this information. It is critical to get ahead of this $1 trillion problem that's going to be needing solutions. There's too many problems and not enough problem solvers. So congratulations, you're on your way to becoming a distressed debt real estate expert.